Welcome to the deep dive. We are jumping into a really high stakes financial scenario today. We're looking at two massive crises that are kind of playing out at the same time.
That's right. One is this immediate, almost chaotic drama around Federal Reserve's December meeting.
The one that's happening right now?
Exactly. Maximum pressure, and critically, they're working with incomplete data. But then there's this other, much bigger story.
The slow burn crisis. We're digging into some deep academic research, actually, from the Fed itself that suggests the golden era of stock market returns. You know, that 5.5% real growth we all got used to for 30 years.
Might have been an illusion, fueled mostly by, well, by luck.
So our mission in this deep dive is to unpack all of this for you. We'll look at what's driving the volatility today, and then we'll ask if the last 3 decades of gains were built on a foundation that's now, well, basically gone.
Let's start with the immediate trauma, this FOMC meeting, December 9th and 10th.
Right. So the market is pricing in something like a 90% probability of a 25 basis point rate cut. On the surface, that sounds pretty straightforward.
It sounds simple, but it's not. What makes this so fascinating is that this cut is happening under, enormous internal pressure. It's going to be contentious. And there's this information blackout.
A recipe for volatility.
A perfect recipe for volatility, yeah. Let's start with the division inside the Fed.
The core of it is that dual mandate, isn't it? Price stability versus employment.
Always. And to cut rates now means they're prioritizing the job market, which they call faltering, over the inflation fight. And inflation is still above their 2% target.
So they're actively choosing to help one and risk the other.
They are. And the committee is deeply split on this. You've got the doves, led by big names like John Williams at the NY Fed and Governor Waller.
And they're saying policy is modestly restrictive and it's time to ease up.
Right, before the job market really takes a nosedive. But then you have the hawks.
People like Susan Collins from the Boston Fed, Jeffrey Schmidt from Kansas City.
And they're waving these huge red flags. They say, hold on, be cautious. You cut now, with inflation not quite dead, and you might have to slam on the brakes even harder down the road.
And this is where it gets really dramatic, the missing data twist.
Yeah, this is unsettling. They're trying to make this incredibly delicate call without crucial economic stats.
Because of that 43-day government shutdown that ended last month in November?
Exactly. So they're deciding on rates without the latest October employment numbers, without the current CPI data.
They're flying blind, literally flying blind into a huge policy decision.
It's like trying to land a 747 in a storm with cloudy instruments. And this disagreement, it's not just chatter. It's going to be visible, historically so.
Analysts are expecting at least 3 dissents on this cut.
At least. And to put that into context for you, 3 dissents is the most we've seen since September 2019, if a 4th person dissents.
Which is possible.
It is. Then you're looking at the largest dissent since October of 1992. That's more than 30 years ago. That kind of dissent signals a broken consensus at the very top.
So the big question for anyone listening with money in the market is, how does the market react to that when the Fed itself looks so fractured?
Well, we're already seeing it. The market is bracing for a bumpy ride. The volatility index, the VIX, it spiked almost 10%.
And that's not just a random number.
No, it tells you the stakes.
Yeah.
Historically, stock volatility averages about 22.5% in the month right before rate cuts start. That's way higher than the usual 15%. So when the Fed moves like this, the ground gets shaky.
Which leads to this idea of a hawkish cut. That seems to be the most likely scenario.
It's Powell's high wire act. He has to give the cut to appease one side.
But wrap it in really cautious language to appease the other.
Precisely. It's a cut, but with a very stern warning about the future. You want to watch the statement language very closely. They'll probably shift from talking about additional adjustments to focusing on the extent and timing of future moves.
It sounds like a small change in wording.
It's a huge signal. Additional implies more are coming. Extent and timing means don't hold your breath. It tells the market that the next cut isn't a given, and 2026 is going to be slow and uncertain.
A real letdown for anyone betting on a quick pivot.
A big one. And, historically, the market's reaction really depends on why the cut is happening. The S&P averages a nice 14.1% return in the year after a cutting cycle starts, but that's misleading.
Because cuts during a recession, like in 2001 or 2007, led to terrible returns.
Awful returns. But cuts during a soft landing, like back in 1995, were fantastic for the market. So the question is this maintenance or is it an emergency?
And then there's the whole balance sheet drama adding to the tension?
Yes, quantitative tightening, QT, officially ended on December 1st. And that's putting a real strain on liquidity in the system.
You can see it in the data, right? In that SOFR Fed funds spread.
Yeah, without getting too technical, that spread is kind of the canary in the coal mine. When it gets volatile, it means banks are finding it harder or more expensive to lend to each other. Liquidity is getting tight.
And so there's speculation the Fed might have to step in with some kind of reserve management purchase program.
Which sounds technical and boring, but it's basically stealth easing. It's them adding liquidity back into the system, which would almost certainly push the dollar down.
Okay, so that's the short-term chaos. A divided Fed, flying blind, dealing with liquidity issues. It's a lot.
It is a perfect storm for volatility, but we have to connect this immediate problem of the cost of capital to the much longer-term story.
Right, because that's where this academic research comes in and just it completely reframes the last 30 years of investing.
It really does. So this Federal Reserve Board paper looked at market performance from 1989 to 2019, and its central argument is, frankly, stunning. It says that the incredible 5.5% real annual growth of the S&P 500,
The growth we all built our retirement plans on.
that it was an anomaly,
Yeah.
something that cannot be repeated.
Yeah.
And the reason why is the secret engine that was driving it. It wasn't genius CEOs or amazing technology.
It was two things, falling interest rates and falling corporate taxes.
Two external mechanical factors, and you can quantify it. The paper shows that those two factors alone mechanically explain over 40% of the real growth in corporate profits.
Wait, hold on. Over 40%. So nearly half of the profit boom that defined the 90s, the 2000s, all of it, it wasn't really earned in the traditional sense.
It was subsidized by cheaper debt and lower tax bill. That's the core finding. The engine wasn't better, it was just running on cheaper fuel.
How did it prove that?
They look at real earnings before interest and taxes, EBIT. And EBIT growth was actually a little bit lower during that golden era, about 2.2% a year than it was in the 30 years before that.
Wow. So companies were actually growing their core operations slower.
A little bit slower, yes. But the profits that made it to shareholders were accelerating because less was getting siphoned off by lenders and by the government.
That's the mic drop moment right there.
It is. There's a chart in the paper showing aggregate interest and tax expenses as a share of EBIT. It basically got cut in half. It went from 54% in 1989 down to just 27% in 2019. Every point that dropped was a direct windfall to the bottom line.
And this also explains why valuations went through the roof, the PE multiples.
It explains the entirety of it. The paper is very clear. The 10-year Treasury yield fell 6 full percentage points over that period. That decline in the risk-free rate explains all of the expansion in the PE multiple.
Because lower rates make future earnings mathematically worth more today.
Exactly. So investors were willing to pay a higher and higher price for every dollar of those subsidized earnings.
Okay, so if the entire 30-year run was built on this non-repeatable engine of falling rates and taxes, the huge question is, has that engine hit a wall?
And the research says, yes. A resounding yes. The mechanical boost is unlikely to continue. They've hit their structural limits.
You can only cut rates and taxes so far.
Precisely. Look at interest rates. The 10-year Treasury was at 1.9% in December 2019. I mean, that's exceptionally low. Given a 2% inflation target, that's basically a zero real cost of borrowing for the government. There's just very little room for rates to fall further and give that same boost.
And the tax side is the same story.
Same story. The effective corporate tax rate went from 34% all the way down to 15%. With U.S. debt to GDP near all-time highs, another huge corporate tax cut seems politically and fiscally very unlikely.
So if we accept those limits are real, what does the future look like?
The paper lays out a conservative forecast. If you assume rates and taxes just stay near their 2019 lows, then corporate profits can only grow at the rate of EBIT. And as we said, EBIT has historically grown a bit slower than real GDP.
Which is projected at maybe 1.9%, 2.0% a year.
Right, which leads us to this really stark new reality for anyone planning for the long term.
What's the number?
The analysis suggests that future real longer-run stock returns are likely to be no higher than about 2% per year.
From 5.5% down to 2%. That is a seismic shift.
It's a different world. It means a huge chunk of the equity premium we all enjoyed for 30 years wasn't really compensation for risk. It was just good luck.
So this brings us back to the short term. If we're entering this new low-return world, how close are we to the next actual downturn?
You could look at the yield curve for a clue. That inverted yield curve, the 10-year versus the 2-year yield, it has a phenomenal track record of predicting recessions.
But the inversion itself isn't the final alarm bell, is it?
No, that's the key point. The real historical warning sign that economists watch for is the curve's uninversion. When that spread turns positive again, That move often happens about a year before the recession actually hits.
So if you're watching that signal, it's a sign to become more defensive.
Historically, yes. Increased defensiveness has been the prudent move once the yield curve rights itself.
So let's tie this all together for you, the listener. You are standing between these two massive financial realities right now. On one hand, you have the immediate chaos of this divided Fed operating in the dark.
Which pretty much guarantees some stomach-churning volatility in the near term.
And on the other hand, you have this long-term structural certainty. The idea that the great lucky tailwind of cheap capital that boosted everyone's retirement accounts for 3 decades is mathematically over.
The best-case scenario for real stock returns has structurally fallen from 5.5% to maybe 2%. The growth we thought was from innovation was actually, a mechanical subsidy.
And if the market today is still priced for that old, lucky 5.5% growth rate, this new 2% reality is going to force a massive repricing event at some point.
And that leads to the final provocative thought we want to leave you with. The S&P 500 is flirting with all-time highs, right? It's priced for a rate of growth that this research says may no longer be possible. If and when the market finally adjusts its long-run expectations down to this new, more conservative 2% reality, PE multiples won't expand, they will contract aggressively. So what happens to the market when it finally realizes the golden era of profits was based on a disappearing accounting trick?